if you want to just go purely by the numbers, when we walk through that kind of scenario, getting, just no moves, further moves by the Fed this year, no cuts, no hikes, stickier inflation than anticipated, and say 10-year yields, sort of settle out around the recent highs. Our work says that knocks the PE multiple down a little bit below 21, and pulls the S&P 500. If you're looking on my earnings, which are 237, around 4,900. If you're looking a little more generously at consensus earnings, which are around 245, you get closer to 5,100. But either way, we think there's some modest downside from here. We do think at this point in time, based on our modeling, this idea of getting one, maybe two cuts, and kind of inflation coming down to 2.6 on PCE, that seems to be fully reflected in stock prices around 5,300 if you use the consensus earnings numbers. So we think we're fairly priced for that rosy scenario now, and if we don't get it, not a ton of damage to the market, but some modest impacts.
Are you surprised, Lori, that the market has risen? I guess we're up 12% or so, somewhat this year, despite the fact that this market, again, went into the year discounting maybe 5 or 6 rate cuts, and now we're down to maybe 1 or 2. Despite that reduction in the Fed dovishness, the stock market's kind of risen here, 12%. Are you surprised by that?
Well, I think it's surprising from a Fed inflation interest rate angle. I think if you put it in the context of all these conflicting cross currents that we have, the big tailwind that's actually, I think, responsible for most of that appreciation is the economic tailwind. And so I love these stats, but if you look at the ECFC data on Bloomberg, and I look at this stuff every Friday, and you can track the consensus GDP forecast on the street, if you look at the 2024 number, last summer it was 0.6% for 2024 on real GDP on the annual basis. If you looked at that stat in January, it was 1.3%. And then I think it was sometime in February, we saw a big melt up and it crossed over the 2% mark. And now I believe it's sitting around 2.4% or so. 0 to 2% GDP is typically very weak for the equity market. 2 to 4, typically you get, kind of a 12 to 13% type gain. And that's about what we've gotten so far this year. So we've exited economic purgatory, and we've moved into the idea that the economy is actually pretty healthy.